There we go. I managed to do it. First time, new software, and I managed to make it work. I'm a very advanced technical person, Jason. I don't know if you know that. I have my IT background's really coming into handy to work the podcast software.
Okay.
So, hey man. So thanks for joining us. I appreciate you jumping on. We chatted before because this infinite banking term seems to continually come up from people that are like, hey, you should look into infinite banking. And, so I don't know if there's, I don't want to say misconceptions, but I think sometimes there's people just need an understanding of kind of what that term means, where you're coming from with that term, and to give everyone some context as to kind of who you are and why maybe we're looking for kind of your opinion as to what you think about this. Can you kind of explain to everyone just kind of who you are, the company you run, kind of what you do as part of this infinite banking world?
Oh my goodness, yes. Well, I'll say firstly too, though, sincerely very grateful that you invited me to be a part of your show, and happy to add value to your community and to bring some clarity and some truth, around this concept that I've been personally, practicing since July of 2008, and have been educating people across North America on the concept ever since. And what gave rise to it was I was introduced to this process and I had no earthly idea what it was. So the very same question came up for me when somebody said, hey, you got to come out to this event, which just happened to be in the United States. It wasn't even in Canada. And I was invited to attend. There were about 300 plus people in attendance. And the hosts and the speakers were speaking about the infinite banking concept. And I had no idea at that time who the developer of the process was, who pioneered it, what problem it was engineered to solve. That was all new to me. And
were you in the financial world already?
No,
what were you doing before? Like what was your background?
Yeah, thanks for asking. We talked a little bit about IT before the show. You made a comment about your experience in IT, and I was a senior partner with Dell. So I was in a completely different realm. I had no experience in the financial sector, and I wasn't licensed in this area at all. But what really struck me at that event is that I knew that there was something that was just fundamentally wrong with what was going on out there in the world financially. I mean, that was right in the midst of and right on the cusp of one of the worst financial crises that we had ever been through, right? So I knew that something wasn't quite right, but I just couldn't put my finger on it. Mm-hmm. And when I came back from that conference, everything that I had learned, and remember, I wasn't licensed to provide life insurance solutions to anybody. I was just genuinely curious to trust but verify what I had learned at this conference. And so I started meeting with all these life insurance carriers in Canada that provide dividend-paying, participating whole life insurance contracts. And I started to lead them through a series of questions to say, look, here's what I'm hearing. Can you trust but verify what I've learned? I'm genuinely curious to know if everything that I've heard is in fact accurate. And true to form, the carriers were coming back, and a lot of the questions, the responses were, nobody's ever asked us that before. Let us find out for you. And so that due diligence process took several months for me to complete. I began to immediately implement the process to the degree of my own limited understanding of it at that time. And that has led us to where we are today. It was a domino that tipped over for me, but one of the biggest was meeting my late mentor, R. Nelson Nash, who's he's right here next to me. Every meeting, every interaction that I have, I was blessed to meet him in 2011. And so I had already been implementing this process in my life for a few years before I had the opportunity to meet him. And that instantly triggered a mentor-mentee relationship. And I was blessed beyond the definition of good fortune to be mentored by him right up until his passing in March of 2019. And for your listeners and viewers who are unaware, where this concept originated was R. Nelson Nash, who wrote the book titled Becoming Your Own Banker. This is a 92-page read, takes a little bit less than an afternoon to get through, but it opened my eyes personally to a whole new financial world. And when people read it with an open mind, it has the same net effect. But the essence of the concept the infinite banking concept is first and foremost to understand that it's a process. It's not a product. And a lot of the feedback that I hear from the financial sector is the same old playbook that gets trotted along and trying to compare one product to another, or you should be putting your money here rather than putting it there. And they're just not understanding the message or not understanding what the concept is engineered to do. As a process, it's all about controlling how you finance the things that you need throughout your lifetime. It's not about addressing the yield of an investment, has absolutely nothing to do with investments of any kind. It's all about controlling how you finance the things you need throughout your lifetime, which can certainly include investments, but it has nothing to do with addressing the yield of any investment function or any investment product. And if I can share one of the examples that has worked really well in helping people grasp this. Well, firstly, feel free to dive in, and then I want
you to share the example, but just to give everyone some context, your role now. So because I kind of interrupted like what you were doing before, but your role now. So you went from, and we don't have to go through the journey, but you went from that initial meeting. You're like, holy crap, this thing makes sense. You started implementing yourself, got into that world. And now, just for context for everyone, the official title, I believe you're CEO of Ascendant Financial. Is that correct? Or I'm butchering that?
No, that's correct. Yeah. Okay. So I founded the organization. So I've been in practice since just prior to 2009 and have been specializing in this process ever since. And we have an incredible team that serves Canadians coast to coast. And the Ascendant Financial organization is a managing general agency. And so we are obviously well organized, well resourced, and equipped to serve our clients. And
you're probably the national leaders on this concept. Is that fair to say, or one of them? I don't want to take anyone else off, but I think you're
I would say yes. I would say truthfully, yes. We have a number of remarkable colleagues in the industry, all due respect to some really amazing people who are not affiliated with our organization, who do the best that they can at serving the general public with this process. But this is what we do day in, day out, and have been doing since inception. And
cool. So what was so I cut you off. So what was the example then you were going to share?
Yeah. So if you remember, real estate, the folks in the real estate community tend to grasp this rather quickly. But an example that really resonates, I've found every time I share it. So when Rebecca and I, my wife, Rebecca, we have 4 children, and we purchased our first principal residence back in April of 2008 when we moved back from the United States to Canada. Okay. And when we bought our principal residence at that time, you could still get 40-year amortization schedules on mortgages. And so we were like, oh my goodness, this is great, right? We got a really low rate of interest. We got an extended amortization schedule. So we thought, hey, the world is our oyster financially, low payment, easy to manage. We're off to the races. And when I began to implement this process, it required me to first and foremost purchase the tool in order to be able to implement the process. And the best tool to get the job done is dividend paying participating whole life insurance, ideally with a mutual life insurance company. And so my wife, Rebecca, and I started to pay premium to purchase these insurance contracts, which are not an investment. These are unilateral binding contracts. And these contracts begin to accumulate what's called cash value, which is not money. And there are many folks in the financial sector who don't realize that. Cash value is not money.
Well, they need to rename it then. It sure sounds like money when they name it cash value, right?
Yeah. So you and I can agree that words have meaning.
Yeah.
Can we agree with that?
Yeah,
so
sure.
If they were to name it policy equity, well, then that would really resonate with me, because as someone who's very active in the real estate space myself, I can relate to that. But what the insurance company provides the policyholder with is a contractual guarantee that the cash value of the policy is contractually guaranteed to match the total death benefit of the policy by age 100 of the life insured. So what that means is that every day that the life insured is aging, the cash value of the policy is growing and it cannot go backward. So the reason that resonated with me was not just the contractual guarantee, but it was the fact that I could borrow against it on demand on my terms.
Yeah.
Now anybody in the real estate space, there's not a single real estate investor who has ever told me, Jayson, I would prefer to access capital on someone else's schedule, on someone else's terms. I would much rather not be in a position of total and absolute control as it relates to financing that thing, whatever it is I plan to finance. So in my wife, Rebecca, and I's case, we set a very defined objective. I was 32 years young at the time, and I picked a number arbitrarily. I said, look, by age 45, I do not want to have any mortgage debt. I want to be in a position of total and absolute control as it relates to everything that we finance throughout our lifetime. Property, business equipment, vehicles, cars, education, weddings, post-secondary education, whatever it may be.
Yeah.
Well,
so you built up the cash value of that policy to the point rapidly, where you were there. Yeah.
Rapidly. And then what we did is we got rid of the conventional bank that held the mortgage. We got rid of that bank 33 years ahead of schedule. We weren't debt free. All that we did was utilize the life insurance company's money to get the conventional bank out of the way 33 years ahead of schedule. But here's what a lot of people, once they grasp the mechanics of what's going on, it clicks. There's a big light bulb moment. So you remember when I talked about the cash value being contractually guaranteed to grow on a daily basis? That
yes,
growth,
sorry, I'm ready a question because I don't want to interrupt you, but I got a follow-up question. Okay, go ahead.
But that growth is uninterrupted by an outstanding policy loan balance. And so as we were requesting these loans from the life insurance company, firstly, there's no credit check. There's no income verification. The loans are unstructured, meaning we control the repayment schedule. The lien for the loan balance is on the death benefit of the insurance policy, not the property. Yeah. So as we began to request these loans and the amortization schedule was coming down and down and down, we got to a point where the bank said, hey, do you realize you've exceeded your prepayment privilege? So you're going to have to pay a 3-month interest penalty for every future lump sum that you apply toward the balance of this mortgage. And so I was like, isn't that on an annual basis? Like, I'm a little confused. And the lender said, well, look, you want to give us a check for $50,000? We got to charge you a 3-month interest penalty. I said, well, would you mind just running the amortization schedule to tell me how many payments that's going to take off the original 40-year amortization schedule? And when she came back and she said, it's going to be a few years. I said, can you go ahead and charge me that penalty? Because the entire time that was taking place, my cash values and my insurance policies were going up. So when we got rid of that conventional bank, we had a policy loan balance to the tune of about $226,000, give or take, somewhere in that range. And the monthly payments that we would have otherwise been contractually obligated to continue to send to someone else's bank are now being redirected back to the life insurance company, not our policy, but back to the life insurance company that we co-own. So the first phone call I made was to this guy. And I said, Nelson, I've got some incredible news for you. He said, what is it? I said, we got rid of the bank. He said, well, don't celebrate too quickly. I said, come again? He said, well, look, your intention was to honor the original amortization schedule. Your intention was to pay the bank what you owed them. Am I correct? And I said, Nelson, absolutely. You're absolutely right. And he said, well, be an honest banker. Finish the original loan schedule. You're just changing the process of who's getting the money. In that moment, that was like a 2x4 in the face moment for me. I don't know if any listener or viewer has ever been hit in the face with a 2x4. I don't mean
hopefully not. Literally not. Yeah.
But now this has blossomed into, we have 77, I say that again, 77 dividend paying whole life policies in our family, 27 individual lives insured. Our annual premiums are $1,356,000 a year. I think that clearly demonstrates my belief in the value.
So you're a believer.
Real estate investing isn't always easy, but it can be relatively simple. And that's where the Rockstar Inner Circle comes in. Look, there's a lot of real estate investing information out there these days. That's why it's so important to pick your sources wisely. And even though investing isn't always going to be the easiest process, it does not have to be super complicated. That's where tried, tested, and proven strategies like the ones that Rockstar members use come into play. Everything shared in the inner circle is built from firsthand on the streets experience in the current market. It's all up to date, things that people are actually implementing today. In fact, the ongoing courses are delivered live, so they're always up to date with the absolute latest real life experiences. As a Rockstar member, get ongoing access to over 20 different systems and programs covering things like which properties investors like and why, our private rental system, what opportunities the investors are scooping up in student housing currently, the legal side of investing, why or how to use corporations as an investor, a mortgage class with the absolute latest options and programs to build your portfolio as an investor because they're different than a regular home buyer. And there's a whole ton more in all those different classes. Of course, to implement all these strategies, members get access to unlimited private one-on-one coaching with an actual human experienced investor, not an AI chatbot, not ChatGPT or anything like that. It goes beyond training, classes, and real estate. It's a community for people looking to take control of their own finances, to give themselves options and allow them to live life on their terms. With ongoing live and virtual opportunities to connect, it's built for investors by investors. You can see everything members get at rockstarinnercircle.com/member. It's rockstarinnercircle.com/member. Now back to the show.
But so, okay, explain something to me here. So
Yeah.
the value of the policy. So for you to be able to borrow against that policy, in the example you use, your wife and yourself, well, you've essentially contributed to that policy just as much as you would have needed to pay off the mortgage. I mean, it's almost like it's very, very similar number. Like, so let's use round numbers. If you needed whatever, I think you said it was 230 grand. So let's just round it to like 200 grand. So if you needed 200 grand by that time to pay off the mortgage with the bank, you would have had to contribute, I don't know the exact number, but probably pretty close to 200 grand to that policy to be able to borrow that money back. Is that right?
No. So we were gradually and incrementally buying down the mortgage. So we didn't pile up all the money and then take care of this in one transaction. So like on our first set of policies, I think our premiums were $16,800 a year. And when somebody hears that, when they think of life insurance and they immediately think of death benefit, they look at the premium and they go, what on earth are you paying that much premium for? Like, you can buy term life insurance and you could pay $58 a month and get the same amount of death benefit. That wasn't the rationale as to why we were doing it. And by the same token, we sit down and talk to people about contribution limits and other, investment in vehicles where you can contribute up to $29,000 a year, and nobody balks an eye at it. But to answer your question, let me give you an example.
Well, hold on. Let me just to make it clear, because I want to keep it simple. Because if I'm contributing $10,000, like I can't have a policy and contribute $10,000 a year for 5 years and then go borrow $100,000 from the policy against the cash value.
No, you're absolutely right. And so
isn't it the same as like that's where sometimes I think there's confusion, because some people will look at it, they're like, okay, I get it, I have this insurance component, but I'm putting the money in, give or take, there's some return because there's a smooth return and stuff like that. But give or take, I'm putting the vast majority of the money into the policy that I'm able to borrow back. So then the benefit in that case is really just that the interest, to you guys, is that the interest is, if when you can borrow it back, the interest isn't going to a car company, if I bought a car, or the bank if I bought a mortgage, or whatever other company, because now I'm able to use those funds separately, like differently. I'm able to use them and pay them into the insurance company versus paying those other financing companies. Do you know what I mean? Like I feel like I'm not actually gaining. Like,
you're on the right track.
It's like a piggy bank. Like I could have put the money in a piggy bank, and I would have had the similar amount of money, and I could take the money from the piggy bank and pay off the bank versus take it from the insurance company and pay the insurance company back. I don't have the insurance component of it, but isn't it the same thing?
Well, so let's address the piggy bank example. So one of the policies that we utilized to achieve the outcome that I shared with you.
Yeah.
That particular policy, and remember, we did this gradually and incrementally. So by about year 3 into our journey, we ended up with multiple policies in our program.
Okay.
And so one of those policies that was added later in our journey, we pay $35,000 a year in premium into that policy. that policy coincidentally just renewed recently. Do you know what the cash value growth in the policy was last year?
I don't know, 35,000.
57.
Okay.
How's that for a piggy bank?
Yeah, but that's just, I mean, can't you look at that with any, how many years have gone by?
Great question.
Because now we're looking at the compounding effect of a return on any investment that is outstripping that. Do you know
It's
what I mean?
not an investment. So here,
Okay, but the comparison I'm using is I'm using a comparison of a vehicle that I can put my money that would return some sort of benefit to me, financial benefit that way.
Right.
And maybe I should. And I think you're saying I shouldn't be comparing it to those, but I'm looking at that as there's an opportunity cost, and if I invest, 30 grand a year, whatever the cost is over 10 years. Because of the compounding effect, I could be earning more than the 30 grand back in that whatever vehicle that is. I'm doing a crappy job of explaining myself, but do you know what I mean?
No, I don't know what you mean.
Okay, so in the policy, you're talking about in this policy, I don't know how many years you've had it. Let's pretend.
So Nick, let's just, unless you understand the problem, the solution just won't matter to you.
Yeah, but I understand the problem. I think we have to look at it. If we don't know the tools to fix the problem, then we can't.
Right. So if we talk about a tool, but we don't talk about the problem we're solving, then the tool doesn't matter.
Oh, okay. I thought we did. Because didn't you talk about the financing things was the problem?
That's not the problem. That's
That's
what the process enables us to do.
Okay.
Problem is we're doing all the work and everyone else is getting all our money. So when we earn income, regardless of the source of the income, T4, interest income, real estate income, dividends, take your pick. Is it not true that at present, for I would say the majority of your community, would it not be true that at present all of that money is flowing through the books of someone else's bank?
The majority, for sure. Yes.
Okay. So we earn an income, we pay taxes,
Talk to me about taxes.
Thank you. So, yeah, because people will spontaneously self-combust when they hear the word taxes. But here's the deal. We earn an income, we pay taxes, we systematically begin to transfer all that capital away from us permanently. Every transaction, regardless of what we're buying, paying cash for, leasing, or financing, we systematically transfer all that money away from us. We can't earn interest on it again. We can't spend it again. We can't save it again. It's a permanent transfer of money away, not just for you and I, but for every generation that comes after us. Is that a problem?
It's not the preferred method, for sure.
Well, that wasn't my question, though. Do you see that or view that as a problem?
I don't. No, I view it as I'm taking.
And the solution won't matter to you.
Okay, because I have to live. So I don't look at it like if I'm taking my money and I'm going to buy some nice steaks that I want.
I get it.
I'm happy to make that exchange in value. So no, I don't see it as a problem.
I get it.
But does walking into the big bank, am I happy to walk into a big bank and have to do cartwheels for them and for them to dig into my life and me get on my hands and knees and beg them to, hey, I promise I'm going to pay you back. Can you please maybe consider potentially giving me some money if I'm up to your standards?
Right.
I'm not a huge fan of that approach. No. You know what I mean? So that's where I'm coming with this. So I don't see the fact that money leaves me as a problem. Because I get things in return.
Then the solution won't matter to you.
Okay, well then I guess that's the end of this. Yeah, I don't know. No, but I just mean I guess I've never approached my life like I need to keep every single. This is outside of the conversation, but the way I look at it is I'm here to enjoy my life, and if I'm earning dollars by exchanging value into the community that way, and that's how I earn dollars. Right. I'm happy to exchange those dollars for value from other people and give them that value to do other things with.
Right.
But I guess I'm but I understand. I understand where you're coming from. Where on like the interest component on larger purchases, yes, I understand that. That makes sense. I'm not a fan of the banking sector. I don't think it's structured properly. I don't think, my God, why do I not know this? The way the financial system is set up through money creation is I don't agree with that, and that those people at the top that are closer to the money can then get easier access and benefit from that in a greater way, and then the majority of people don't get the benefit of that because they don't get this money creation aspect to it. Right. So if that, so to further the answer, then there are aspects of it that I believe are a problem. Yes.
Okay. Well, I appreciate you sharing that. And so when I need access to capital, if a high caliber opportunity tracks me down and I need access to capital to take advantage of that opportunity, or I need capital to finance something, if I have, as I do, ready access capital on demand on my terms, and I'm in a position of total and absolute control as it relates to a repayment schedule, and the lien for these loans that I choose to access, nobody forces me to do that, is on the death benefit of my policies and not the assets that I'm buying or investing in. Is there anything stupid about me financing the things in life that I need in that fashion?
No.
Right. And so if we just maybe go through a bit of a crash course in logic, if I recognize the fundamental truth that my money must reside somewhere, no different than yours. Our money must reside somewhere. And that we either pay interest to someone else to access their pile of capital, or we permanently give up the interest that our own capital could have otherwise earned. There are no exceptions to that. Much like anybody who believes there is would believe that the law of gravity doesn't apply to them.
But hold on, are there exceptions to that? Because the way you're explaining it doesn't make sense, because you're looking at interest as an absolute. But if I take my money and I put it in a savings vehicle, like call it a sound form of money as an example.
Yeah.
Well, then where does the interest apply? Like, I saw a chart the other day and it caught me off guard. I was actually surprised by the number.
Yeah.
The compound annual growth rate I'm not saying that the insurance is an investment, but I'm just looking at this as an example. If I parked my money in gold from the year 2000, because this was the chart, in Canadian dollars, the compound annual growth rate was 9.3% annually, compounded. Pretty solid return. So what we debase our currency at about a 7% clip rate right now, right? So call that inflation or currency debasement, whatever you want to call it. Yeah. So why do I have to park my money someplace why do I have to be looking at this interest in the first place? If I have a good solid form of money, can't I just keep my money or the value of that money in these other assets?
Sure. You can do whatever you'd like with your own money. So if I want to invest in something or finance something, I'm not using my own capital to do that. My capital is residing with an insurance company that I co-own that since inception has never failed to produce a divisible surplus. I pay zero taxation on the buildup.
Yeah, that's exactly this one, yeah.
I pay zero taxation on the death benefit proceeds.
Well, you're dead, aren't you?
The contract is exempt from the passive investment income tax rules. It's the greatest benefit that exists in the Canadian tax code today. I can contribute almost unlimited sums. I have ready access to capital on demand on my terms without reducing the asset's value and without triggering a taxable event. So logically, how much of my capital do I not want residing there? Because from that place, I can go and invest in gold. I can invest in real estate. I can deploy capital. And I'm in a position of total and absolute control. If I have money in gold, if I have money in savings, and that savings resides on the books of someone else's bank, you and I don't believe for a moment that bank's letting that money sit still, do we?
No, of course not.
right? So the bank's putting the capital to work for the stockholders of the bank, not the people who left the money there. And if I co-own the insurance company and there are no stockholders to be responsive to, and all the capital is being deployed for my benefit and the benefit of everyone else who co-owns the company, and I get to participate in that divisible surplus with a company that I did nothing to build. I'm not responsible for any of the employees. I'm not responsible for any of the day-to-day operation of the business. My sole responsibility is to pay the minimum required premium of the policy. That's it. And I immediately co-own a business that's never failed to produce a profit because the outcome is engineered. So logically, and I'm only speaking for myself personally, I'm not suggesting that anyone else embrace my thinking around this, because I want you to think about your thinking, not mine. But when I'm invited to share my experience on shows like yours, I'm only giving people a glimpse into entering my 17th year in this journey. And of the thousands of clients that we've served, that we've been blessed to earn all these amazing reviews from, all these amazing testimonies from, not one of them has ever called us to say, I'm really pissed off that my cash values keep rising every day and that I'm in a position of control as it relates to the banking function pertaining to my own needs individually and the needs for my company and the needs for my real estate portfolio. Because if you're a real estate investor, you're an entrepreneur. And so we cannot ignore those voices. What we should do as an advantage is investigate that. How can all these people be right about their experience with this process? And is there something that either A, I haven't grasped, or B, that I should investigate a little bit further just to rethink my thinking? And if you do, I'm not saying you, Nick, I'm just saying in general, this process, once you understand what's really going on, you'll know exactly what to do.
Well, so everyone knows I've been down this path a lot, spoken to a lot of different people, not necessarily about the infinite banking concept, but about these types of dividend paying, participating whole life insurance policies. I have one that I think is similar, but it doesn't have the cash value on the high end. It has more insurance value on the back end. Oh, okay. Similar type of concept.
So more like an estate builder.
The estate builder is actually what it's called through Canada Life, because the reasons we got it was for other reasons, whatever. Yeah. But it was multiple meetings even for us to kind of cross the finish line for that one. Yeah. But I've asked a number of people. This is something that I guess I've been playing with in my head.
Sure.
This is what I try to figure out about this whole thing. And it's really because of the questions, I guess, that were not really left from, I think there's, every time I'm paying the yearly policy, I think there's other questions that go through my head about these things.
Okay.
So I gotta have something wrong here. So I'm curious what you're going to explain to me.
Sure.
So let's make some sort of assumption that I've managed, I would have $100,000 over the next 10 years that I could have put into my TFSA, or I have $100,000 that I could have put into one of these types of policies, right? Just to use a round number. My understanding, so the way I've looked at it recently, I'm like, I gotta be missing something, because if I pull that from my TFSA, but I pay myself an interest payment on it. So let's say I pull the $100,000 and I'm going to repay my TFSA with interest, call it 5%, right? So I'm making those payments. I'm obviously need to be very disciplined, and I'm able to make those payments, and I'm paying it back to the TFSA. So I'm still earning money on the $100,000 because I'm paying interest on it myself. Versus if I borrow it out of the insurance company, out of my policy, sorry, I don't know what the term is, but if I use the insurance policy and I take the cash value that I have access to, assume it's the same number of 100,000, I have to pay that back with interest as well. Aren't all, like, on the financial side of earning a return, I know you're not I don't want to look at it as an investment, but on the financial side of looking at the growth rate of the initial capital contribution, don't those work out the same? Like, isn't it a similar, no? How don't they work out the same? Because if you're paying interest into it,
Yeah.
You're paying the interest no either way.
So, and I want to make sure I heard you correctly. So you've got 100,000 in the TFSA, is that right?
Yeah. I'm just using round number. Yeah. 100,000.
And then you withdraw that to go do something with it?
Yes.
What's the account balance?
0.
When you borrow against the 100,000 in your dividend paying whole life policy, what happens to the cash value balance?
Yeah. I'm sure it doesn't change.
It goes up
Why does it go up?
because you're aging.
Oh, well, it goes up in the future. It doesn't go up on
No.
the day that I take the money.
It sure does. So cash value rises daily, Nick. So
okay. But hold on, Jayson, just to be clear.
Hold on.
No, I just want a clarifying point because, okay, go ahead.
Yeah. So one thing that Nelson did such a great job at in his book, which I think you should read.
It's been sent to me. I have it back here, and I've been through it. I can't say I've read every single word, but like I have been through it and in detail.
Well, I think, yeah.
Read it again. Is that what you're telling me?
I would not only say read it again, but one of the things that we're going to do for your community. So we're going to do a pretty extensive deep dive with real use cases. And I think that you're probably going to benefit just as much, maybe if not more.
Okay. Explain the interest to me though.
Yeah. So I'm getting to that. So Nelson did a wonderful job in his book where he described the 4 characters in the financial play. So we've got the depositor. So when you put money into a TFSA, are you a depositor?
Yes.
And we've got the borrower, acknowledging that you're always working with borrowed money, meaning even when you pay cash for things, because you're giving up the opportunity of the interest that money could have earned otherwise.
Okay.
You take the 100,000 out of the TFSA, the account balance comes down to 0.
Yeah, but remember, I'm paying interest on it though, just like I'm paying interest on the insurance. So it is accumulating interest because it's a loan to me. So even on day one, it accumulates interest the same way that it would in the policy.
Well, but you told me you withdrew it.
Yeah, but I'm going to pay it back with interest. So because like any other loan, I would have to pay back with interest, like the loan from the insurance policy, because when you borrow from your insurance policy, you have to pay it back with interest, right?
When you borrow from your insurance policy, the loan is unstructured.
Okay, but does interest accumulate on the money that you take from the policy? Okay, so the same rules apply, similar rules.
But Nick, if we just kind of go back to exactly where we started, I think we're hitting a bit of a brick wall here. If your account balance, if your account balance comes down to 0, Nick, in the TFSA, and the cash value balance in the policy grows, not a single penny, because remember, cash value is not money. So the cash value, the cash value in the policy is uninterrupted by the loan.
Okay.
Whereas you with the TFSA, you depleted the account balance. So help me understand your logic as to how that can be the same thing.
So the requirement when I take out the money from the insurance policy, whatever the term is the expectation is, and I don't know, I've never done it, is that the money is going to be repaid because it contributes to the success of the overall insurance company, because the money gets repaid by anyone that borrows against it with interest, correct? So
No.
So if I take money from my policy, I don't have to pay any interest when I pay that money back to the insurance company.
You do, but there's no expectation of you repaying the loan. The insurance company
because it's secured against the asset.
The insurance company itself is contractually guaranteeing the collateral for the loan. That's why the insurance company does not require a repayment schedule.
I understand. It's also the money that I've already put in, so I can understand that, and I have the policy. I think you're like, we're shifting the conversation. I guess I'm just looking at the numbers.
We've moved away from the plot entirely.
Well, call me, like, maybe I'm just too simplistic. I'm a numbers guy. So I look at it, and if I'm paying, and I understand what you're saying about the balance would be higher, the balance of the TFSA would be 0. But if I paid daily interest into that TFSA, well, then it's going to grow because I'm going to put the money back.
the cash value is going to grow much faster than your daily interest back to the TFSA because the cash value balance was never interrupted.
But it's based on the 100,000 that I borrowed. We're talking about the same amount of money.
No, we're not.
I don't understand how we're not. If I'm talking about 100,000, if I've taken 100,000 and I'm paying hold on. Because I'm obviously missing a big point.
You certainly are.
I'm paying interest on 100,000. It's no different than if I borrow 100,000 from one place and another place, and I'm paying the same payment back. So maybe I'm making too many assumptions, because my assumption is that I'm going to be paying the insurance company back. Remember what Nelson Nash told you? He's like, hey, stick to your amortization schedule.
Absolutely.
So I'm going to stick to the amortization schedule. I'm going to pay the insurance company back with the interest that they're owed every single month on time. I'm paying that back. And because of that, that balance is going to continue to grow my current balance. I'm going to pay back the 100,000 from the TFSA every single month on time with interest, which means the 100,000 that I took out is earning interest still because it's a loan. It's no different than if I loaned 100,000 privately on a private mortgage to someone. I'm earning money on the 100,000 from day one. No,
Nick, it's much different. So what's the death benefit value of the TFSA?
Oh yeah, okay, you're right. That's different, 100%. So the insurance component is different.
But what's the death benefit value?
Oh, zero versus whatever it is. Yeah.
What's the death benefit value of the policy?
Well, yes, not zero.
Okay, and when you pay interest, regardless of the rate, let's assume it's the same rate, like whatever the rate, you decide what it is. When you pay the life insurance company back, who is the insurance company putting that capital to work for? Regardless of the rate.
Well, it's putting it to work for everyone.
Who's everyone?
Well, all of the holders. So I get 0.0001% of that interest, whatever the number is, but it's putting it towards the company. I mean, it's putting it towards the company, because if the company doesn't make money, I don't make money. So it's putting towards the company, and then the profits gets. Actually, I believe it's split into, some companies split it into tranches, but it puts it towards the policyholders. No,
that's right. So the policyholders are the sole beneficiary of the divisible surplus and the residual equity generated by the insurance company. When you send money back to the conventional bank, who is that bank putting that capital to work for?
Well, this example of the TFSA, it's me. But if you're talking about a regular...
Are you certain of that? Is that the truth or your truth?
Well, you're taking who's getting you mean...
Do conventional banks have stockholders?
Oh, sorry. Yeah. I thought you meant the asset value of the.
My question was ridiculously simple. You got the answer correct for the insurance company. So
yeah, sure. Banks are out to make money for the stockholders. Yeah, 100%.
Exactly. And so who are they primarily responsive to, Nick?
Yeah, they're shareholders.
The depositors or the stockholders?
They're the stockholders.
Okay, so if you take the insurance contract, and again, for your viewers and listeners, we're not talking about anything related to infinite banking here. If you take the insurance contract and you just sort of move it off the table entirely, when you put that money on the books of someone else's bank, is that your money?
No.
Whose money is it?
I don't know where you're trying to lead me with this.
Well,
I'm confused.
I'm trying to help you to think about your thinking.
No, because here's the way I view things. Anytime that I give my money to someone else, and maybe I'm obviously not the standard person that looks at this, I guess, because the way it feels like the questions that I'm asking, because anytime I give my money to someone else, I don't care if it's an insurance company or a bank, in my view, there's risk involved. There's always risk. As soon as I don't control my money, I don't trust anyone else to control it the same way. So I think there's more risk involved. So I know the
why would you use a TFSA example? So when you're dealing with a participating whole life policy, let me clarify a few things for you, and let's talk about risk. This is a unilateral binding contract, Nick. It's not an investment. The one party to the contract that is required to legally fulfill all of the contractual guarantees is the life insurance company, not the policy owner. The policy owner's sole obligation is to pay the premium. The insurance company is contractually guaranteeing that the total cash value will match the total death benefit by age 100 of the life insured. That's not a hope and pray it happens. That is a contractual guarantee. How does that address risk?
Yeah, I guess it's
the values of the policy, Nick, cannot go backward. Can you and I agree that there's volatility in markets, that there's real estate cycles, that there's that there's economic turmoil?
Well, look what's happened the last couple of years.
That can put people's investments at risk. Because what is the definition of risk?
That's a good question. I don't know the actual definition.
It's the probability of the loss of value. When you put money into the insurance company, you become a co-owner of a business that has never failed to produce profit. And this is a business that's been operating in our country since 1847. That's irrefutable.
Yeah, I agree with that.
And so your point to risk, first of all, I commend you for wanting to be risk averse. I think that's, outside of the fact that
I'm just old school.
Outside of the fact that we take risk in, building our real estate portfolios or being in business, I have 12 companies in my family group of companies. You want to talk about risk?
Yeah, sure. And responsibility
I sleep extremely good at night, knowing that my net worth is going to be higher tomorrow morning than what it was today. And it cannot go backward. There's no political event, economic calamity, recessionary period. Think of all of those instances that we've experienced over the past century alone. And yet, life insurance companies remain the most financially solvent institutions on the planet. And conventional banks, the very institution that you described having your TFSA with, they pay billions of dollars a year in premium into dividend-paying participating whole life insurance policies, referring to them as the most stable asset, tier one asset on their balance sheet. Is that good risk management on behalf of the conventional bank? So the conventional bank is either really stupid and creating a lot of wealth for their stockholders, or the conventional bank knows something about this tool, this unilateral binding contract, that you and I don't. Which one do you think it is? And don't take my word for it. Just look up BOLI, bank-owned life insurance. Hop on to Uncle Google and start doing some research on bank-owned life insurance. These conventional banks are paying billions of dollars a year. They're buying more of these contracts than you and I and the general public are. That should
some of these banks offer the insurance though? Or no, because they have to pay. They offer simple insurance, not this type of insurance, right?
No. Private banking does. Private banking does offer dividend-paying contracts.
What's that like? That's like manual. That's not like TD and CIBC. That's like manual and stuff.
Yeah, no. All the big banks have private wealth and private banking arms that offer these contracts to clients. And
really, I didn't even know that.
Yeah, and it just begs the question. There's not one of my ultra high net worth clients that has a need for death benefit. And they're the largest purchasers of these contracts.
But isn't the debt?
What does that tell you?
Yeah, no, it sounds good. It leads to so many questions. I have so many questions with this stuff, but it means that I guess the risk is low.
It's not about the risk being low. The party that's assuming 100% of the risk isn't you. It's the insurance company. And when you're dealing with a company that's required to maintain a continuing capital surplus reserve, so these insurance companies, if they fall below a minimum continuing capital surplus reserve, meaning if they look ahead to the next fiscal year and they say, look, we're forecasting we're going to pay out $1 billion in death benefit claims. If the insurance company does not have a continuing capital surplus reserve that exceeds those contractual obligations, they cannot operate as an insurance company. They can't inflate their money pool. Yet conventional banks are creating money where no money existed right now as you and I speak. And so again, going back to the fundamental truth that your money must reside somewhere, what better place to have it reside than here? And it's not an either or. I'm not saying put all your money there and don't do anything. I invest. I build companies. I buy real estate. I lend capital. But I'm not using my capital to do it. Does that sound familiar to you? Whose capital do you think the banks are using?
Yeah, they're using everyone else's.
Right. So if we do what the banks do you think we'll be okay?
Well, yeah, the ones, yes, I prefer to act like the bank, and I prefer to be the house at the casino. like a casino. I don't really want to be the gambler at the table. I'll be the house.
If somebody was to say to me, Nick, if somebody was to say to me, Jayson, look, I think the way you're going about your financial affairs is absolutely ridiculous. I would be more than happy to entertain any counter method that has all the same benefits and more of controlling how I finance the things I need throughout my lifetime. I'd be more than happy to learn that. I believe that there's always something new to learn. There's no such thing as having arrived in knowledge.
I think the way sometimes that it gets, the perception can be sometimes that it's, and you and I had this discussion before, is that it's a one size fits all solution.
Not a chance. No.
And I think that's where things can sometimes get mixed up. I think, and this isn't about this concept. This is about anything. I think there's nothing that's a one size fits all solution. We're in real estate investments. I tell everyone, I'm like, just because I have a property that I think is great for me, you might not want to own this thing ever in your life, and that's good.
Agreed.
Don't do it. Like, there's no such thing, right?
Yeah.
Because like, to me, there's when I look at mine, I guess the question I have, let's forget that stuff, because the question I have, it's not infinite banking question, because it's more around the policy return, because they smooth out their returns. And then I'm like, well, the opportunity cost is I could buy the term policy, have the insurance, and get better return than I'm getting with these guys. And in fact, I feel like I'm losing money, and it's the way the insurance companies can make money, because they're paying you back with inflated dollars, which are worth less, down the road, right? But that's like an insurance company thing. It's nothing to do with infinite banking. That's just life, or that's our financial system.
Well, it's so important to to make sure that the communication is clear, that the infinite banking concept is a process. It's not a product. But yet the best tool to get the job done
is that product, but it's not used a proper way for infinite banking, right?
Right. And my late mentor, and again, God rest his soul, I think about him, I miss him every day. He often said, because he spoke all across North America right up until his 88th year, and he would often say that you can put the best tool for the job in the hands of someone who hasn't been taught how to use it, right? And not only will that person not turn out any good work with the tool, they're likely going to break the damn tool. And so that's why it's really important that someone is working with someone who's proficient at this process. Mm-hmm. And we're not naive. We don't, believe or perceive that everybody's going to work with us. We just encourage people that when you're investigating this process, and you're thinking about a who that possesses the capability to coach you on how to get the how done, ask that individual for a good sample size of client testimonials and reviews. And a sample size of 100 would be sufficient enough, in my view, to demonstrate a person's proficiency in coaching and mentoring somebody through this process. Now, we're blessed with a few thousand, but the truth is I haven't met very many people in the financial sector who could produce even a fraction of that client validation if their lives depended on it. Mm-hmm. And there's a reason that we're receiving this feedback and these insights from people who are actually implementing this process. But all too often, the discussion is immediately shifted toward a product-based discussion. Like, what are we even talking about? The tool. The tool doesn't matter if a person doesn't recognize the problem.
Yeah, I agree with that. But don't you have to talk about the tool? Because if I'm trying to...
Yeah, of course. Yeah. So for additional clarity, like when we are working with a prospective client, there are two roles that we're filling in that interaction, right? The first role is as a life license advisor. In my case, I'm a chartered life underwriter. And on our team, we have certified financial planning, trust and estate planning. We have a CPA, 2 CPAs on our team. And so we have to fulfill that duty of care where we meet with somebody and say, look, what we're talking about here is a unilateral binding contract. It's an insurance contract. It has a death benefit. The death benefit has to have merit. There has to be justification for that. And so we move through a process with our prospective client to determine what that need is. And there's not an immediate, crossover into having a conversation about the infinite banking concept. We're identifying a need. We are regulated and we have compliance, very robust compliance framework in place to make sure that there's a reason why the insurance is being placed to begin with. Then,
so what's the cross? Oh, sorry. Okay.
Then in acting in the capacity as an authorized infinite banking practitioner, being in a coaching and mentoring capacity to show somebody how to utilize a contractually guaranteed loan provision that the policy owner is well aware of and understands the mechanics of, because we coach them through that. And then we provide that ongoing, we have quarterly group client coaching. We have an online client portal, much like you do, which has got a treasure trove of archived resources, including all of our previous quarterly group coaching sessions. We host live client events, virtual client events. We're right there alongside our client to help coach them on the implementation of the process. Make no mistake about it. There has to be a need, a bona fide need for the death benefit. It has to have merit.
So, okay. So, and that's what I was going to ask. So what, because you said you cross like either the life insurance first, and then you're like a certified infinite banking. Where's the crossover happen? Is there a certain set of circumstances? Is it just a train of thought where people like the concept? Is there a certain revenue number? Like where does it?
Yeah. So that's a really good question. It's all a function of educating and making sure that a prospective client has clarity before they decide to do anything at all. Because as you can imagine with our presence on social media, our reputation, people are connecting with us every single day. And we have a process of providing resources to educate that prospective client on the process of becoming your own banker, the infinite banking concept. We lead with that education to say, look, take all the time that you need to develop the insights, the clarifying questions that you have. And we would wholeheartedly encourage you, do not do anything with this process until you have clarity. And that's where our advisor team comes in, and we're meeting with these prospective clients. We're listening to their insights, we're responding to their clarifying questions. And then once we've determined that we can establish a basis to serve them, then that's when we move forward with the implementation of the process itself.
Got it. What's the biggest misconception you think that you guys hear? Because there's always different questions. And, I have, like, I look at, so like, for example, for me, so I guess maybe I'm not as much, maybe the infinite banking side of things doesn't, I don't jump at that as much as like I look at the numbers of the tool. You know what I mean?
Right.
Like, well, if I'm getting this smoothed out return, if I put the money here, I can get a better return, and I can take that and buy some term life, which isn't exactly the same. But like, I do all these kind of like compare and contrast tools in my head.
Yeah.
Versus I'm not thinking of it as I like you're saying, like the concept. You know what I mean? I care more about like, hey, let me just work out the numbers. Like the example that I took, a hard write on with the TFSA example. So what other misconceptions do you guys kind of face with that stuff? Because I'd imagine that's probably a pretty big one. Like you mentioned, you've already mentioned it. Really, like a lot of people veer towards the tool versus kind of really coming to terms with like, hey, do I want this implementing this concept first? And that's what I use to do it.
Yeah, that's such a good question around, misconceptions. I would say that, we run into probably most often conflating the process with the function of investing, right? And that typically comes from the financial sector. You shouldn't put your money into dividend paying whole life insurance. You should put your money into RSPs or TFSAs or RESPs or insert whatever financial product there is.
And what's their argument for that?
Return.
Okay.
And so what I've really tried, my best to do over the years with colleagues in the financial sector is to encourage them to go through it can be actually quite fun, like a critical thinking experiment. If you could design the perfect investment, now the only caveat is that the investment can have no drawbacks whatsoever. What attributes would that perfect investment have? Given the truth that there's no such thing as a perfect investment. This is just a critical thinking exercise to go through, right? And the most frequent responses that come up, because I do training for accounting firms, for family offices, for agencies and advisory firms, and we go through this critical thinking. And the most frequent responses are control, guarantees, no taxation, it has to grow continually. There has to be a high rate of return. There has to
being able to leverage it against it's a good one too. For sure.
There you go.
Yeah,
right.
Yeah.
So when we examine all of these attributes, I just did this recently actually with a life insurance company, and one of their product people was like, okay, let's go through it. So the product people go through it. And I said, now we had this on a whiteboard. If you can envision this, we've got all these attributes listed on the whiteboard. And then I handed this person a marker and I said, if you can just go put an X beside any one of those attributes that dividend paying whole life insurance contracts do not possess.
But aren't you then positioning it the way you don't want it positioned?
No. So the whole point is to meet somebody where they're at in their thinking.
Gotcha. Yeah.
And then to say, first of all, was that a helpful exercise to go through? And people are like, yeah, it really helped me to rethink my thinking around what this unilateral binding contract actually is. It is not an investment. It never has been. It never will be. And so if a person wants to achieve the best yield on an investment, then that's how they should deploy money. They should invest money. But you need to understand that when you do that, you must contend with market risk, tax risk, liquidity risk. When we review a dividend paying participating whole life insurance contract, I think that contract does a pretty remarkable job at addressing all three of those risks. And so whatever you're doing financially, the point being, this tool can only serve to amplify in a positive way what you're already doing or contemplating doing financially. If somebody sat down with you and said, Nick, you've got to pick a lane, because it would be unwise for you to have both of these tools in your toolbox, meaning your suite of investments, whatever those may be, and participating whole life insurance. You need to pick one or the other. That's sort of the misconception that it boils down to trying to beat the stock market. Like Nelson never said to anybody, you should invest less money in the stock market, mutual funds, real estate, gold, silver. What he said was that someone and some organization must perform the banking function as it relates to your needs. There are no exceptions. And most people, and I'm referring to 99.9% of the population, they not only abdicate the opportunity that controlling that function represents in their lives, but they abdicate the responsibility of it. And when you think of the four characters in the financial play, the depositor, the borrower, the banker, and the bank owner, which one of those four characters do you think makes the most money? Understandably so.
Yeah,
Bank owner.
Oh, I was going to say the banker, but yes, bank owner. Yes.
Right.
And the banks never lose, man. That's what we talk about. The banks never lose.
And so when you can position yourself to take control of the function and you can become all four characters in the financial play, then you are at an advantage compared to anyone in your peer group, regardless of what they're doing with their money. Mm-hmm. Because you get to control that function as it relates to your needs individually. And the other myth is that, I've seen some other life insurance products that are sort of commingled with the infinite banking concept, like universal life insurance, variable life insurance, where these are insurance contracts that are tied to market volatility. They're more like term life insurance policies with a slot machine attached to it. And those are not endorsed for the utilization of or implementation of this process at all. Mm-hmm. And so I've seen that. And a fatal error in thinking is that this has anything to do with interest rates or addressing the yield of an investment.
That's interesting. Yeah. Yeah, this was good. And I know we're talking. This conversation, I have no idea why it always leads to more questions for me. So, but I want to respect your time.
Questions get you to clarity.
Yeah. I want to respect your time. I think what's happened over time, and unfortunately, this industry. I'm not saying infinite banking. I think I'll say the life insurance industry. So I'll talk about the tool because I don't really have enough experience in infinite banking. Unfortunately, like any industry, there's good advisors and there's some not so good advisors. And I think I've seen people sometimes, maybe not force, but maybe they really push people towards a policy that maybe it doesn't really suit their financial situation at the time. And I think in our world from dealing with a lot of things, I've seen that a few times. And that's where it gets a little bit, for me, I'm like, I just hate seeing that, because it becomes a burden for them more than a benefit. And when I've spoken to them, the one thing about, I don't know how this industry works. I know with real estate, we always have to disclose all our commissions. Mutual funds, you disclose all your commissions. And again, this isn't infinite banking. This is more of a life insurance thing. I understand that. Yeah. Is I was like, when I got my policy, I don't think I ever had to sign off saying, hey, this guy's earning this much commission. And I wondered sometimes with some of the not so good advisors, and I'm being very clear, there's not good realtors, there's not good lawyers, and there's great ones. And there's, you know what I mean? I'm like, man, did they disclose that by going this route, they're earning this much more in commission? And I'm like, I don't, sometimes I feel that's everywhere though. That's everywhere. I just don't know if that works because sometimes, but it's a little bit broken telephone too, because I don't know truly what the advisor said to them versus what they heard and are now repeating afterwards as well. Right.
Well, to add to what you said, if you're dealing with a reputable advisor who like you said, if you set the infinite banking concept aside, you're just dealing with a life insurance agent or a chartered life underwriter, that advisor will be more than pleased and will already likely have a very robust disclosure framework in place. And in addition to that, it's so important for people to just simply be aware, there are, as it relates to the tool, there are ways to apply premium to a policy in a way that maximizes commission that's paid to an advisor and in a way that minimizes it.
Oh, yeah.
Right. And so as it relates to utilizing a tool to implement the process or setting the process aside, if the objective of the tool is to accumulate cash value rapidly, which is the net present value of the future payment of a death benefit, then that policy would be structured in such a way where the commission would be minimized. And
got it.
Nobody talks about the fact that the insurance company itself sets the commission schedule. And so where a person has some concern and they want to discuss that, it shouldn't be with the professional providing the value. It should be with the insurance company itself. If somebody has a concern with a commission schedule that's been set, that's a conversation to take up with the life insurance carrier, not the professional that's delivering the value to the client. And when you're dealing with an organization, and again, I can't speak for anybody else's organization, but when you're dealing with an organization like ours, where we develop a pretty deep understanding of what the clients we have and the clients we want to have truly value, and we deliver that. Clients never approach us saying, I want to work with the lowest paid person on your team.
Yeah, really? Shocker.
And with all due respect, like that argument comes up from the financial sector, and it's very weak.
Oh, does it really?
It's
what argument?
The argument is, well, hey, don't you realize that, life insurance advisors are paid, and surely they're just motivated by commission. That is an intellectually lazy and frankly weak argument.
Yeah, I agree.
Do we want to get into not you and I, I'm just saying in general, do we want to get into a petty commission squabble, or do we want to talk about the actual value that clients are telling us that they love and that they want to see us continue to deliver to them? Nobody wants to examine all the testimonials.
No, 100%. Look, we're in real estate, and people have been saying realtors are overpaid forever, and some are. Like, some don't work hard, but there's top performers and good ones for a reason, because they're operating in a manner that is far more advisor-like than salesperson.
Right. And
100%. I agree with you. That's an intellectually lazy argument for sure.
But I will say, much like I mentioned at some point earlier in the show, that what we love to do for communities like yours is do a deep dive into the process, and you can look at as many numbers as you want. But again, I'll just say earlier when I mentioned, unless you understand the problem, the solution just won't matter to you. When you come through an immersion, a deep dive experience with real use cases, once you understand the problem, the solution will become very clear, and you'll know exactly what to do. And that deep dive, that immersion, we don't charge anything for it. We know that people are going to, people who catch the process, they're going to want to talk to us about establishing a basis to serve them and to help them. So we are motivated to educate. Of course we are. And we're going to provide that if your community would value that.
Yeah.
So between you and I, we can pin down a date to do it. And I'll even fly down there if you want to do it live and in stereo. I'm happy to do that too. But we just want to make sure that people understand the truth, that they have clarity on this concept, that they can address any clarifying questions or insights that come up, and that we reinforce our suggestion, which is don't do anything with this process until you have clarity.
Mm-hmm. Yeah, I appreciate that 100%. And I think I also appreciate your time. And I feel it was interesting. I wanted to talk to someone about this, and it was hard. I shouldn't say it was hard finding someone. It was just not knowing who to find. So just because of the organization that you run, your time in there, and that you're looked at as, a real kind of leader in this world, I was like, you know what, Jason's the right guy for me to bug with my simplistic questions about this type of stuff and go down this path. And there's going to be more. Hey, I guarantee. I think the payment that I have into this type of policy comes up, and I understand. I keep going back to tool, not the problem, and I need to kind of, when having these conversations, it's a different conversation, but I know that it leads to more questions every September. 100% when I'm writing that check, I'm like, why the hell am I writing this check again? Well, but I have learned now to separate the two. That's one thing that I have learned to separate the two for sure.
Well, and Nick, if I can leave you and your audience with this, in our family, and what we coach our clients and their families to do, if you just picture, because most people approach the process initially just at the individual level. How can this apply to me individually? In our family, because we finance and control that function for vehicles, for home renovations, for property, so we have $80,000 a month of payments flowing back to our family's money pool that would have otherwise been permanently transferred away.
Mm-hmm. Yeah, it makes a difference when you're.
Nobody in the family is asking me about interest rates.
Yeah,
what they care about is the fact that all that we've done. We haven't changed any of the objectives of our family members. We're just changing the process that they're executing to get those objectives achieved. Mm. And that creates a very peaceful, stress-free existence when you don't have to be reliant upon a conventional bank for anything other than the convenience of debit and Visa.
That's a nice thing for sure. And look, we've already run long, so I apologize, but for people looking,
this was fun.
So for people looking to reach out to you, or I think you guys have a bunch of information online as well. So, and I know we might do something else, but just the information, whatever next steps, if people are like, hey, I want to dive into this a little bit more, so, so they understand it further, where's the best place to go for them?
Well, if people like to learn online on YouTube, for example, you can visit two of our channels. So we have a channel named Banker's Vault and a channel named Wealth on Main Street. Both channels have content posted to it regularly that you can access 24/7. And then in addition to that, our podcast, Wealth on Main Street, is a great resource just to keep yourself up to speed on all the content that we share and what we put out there. And then thirdly, is once you and I have an opportunity to pin down a deeper dive, I would encourage your community, invest 3 hours of your time to come out and learn something new. And it'll be a great investment of your time, that I can assure you.
All right. Perfect. Jayson, thank you very much for taking the time. I really appreciate it, man. It was good. It was good talking to you. And I know I kind of took it off in a little bit of a turn there, but there's few people you can bounce that type of thinking off. So I appreciate being able to bounce it off you.
Oh, happy to be here. Thank you for having me.